I have shared this handout last week itself, so you can go through it. Credit supervision, monitoring, and follow-up. Hope you can remember. I showed you pre-approval monitoring and post-approval monitoring. Pre-approval monitoring is to deal with from the day we originate a customer, from the day a customer comes in to the day we approve the facility. So different references, business and residential visits, collateral visits, invoice submitted by the customers, and authenticity. Especially whatever the documents they provide, we should check the authenticity, because we have found so many malpractices customers are doing, right? Everything should be checked independently. If an invoice is given, you should call and check the authenticity, not just take the invoice, right? Like that, prior to approving the facility, you should monitor the behavior of the customer. If customer is not honorable, or if his character is negative, as per our knowledge, we should never give funding, because character is the key in credit, right? Then we go to, after the disbursement, after the approval, we go to the disbursement. Once the money is given, whether it is short term or long term, money has gone out of the bank. So your aim is to collect that money as per the agreed schedules, right? So you should do site visits. It has to be planned visits as well as ad hoc visit, as I told you earlier. Always you should not give the money to get everything at once. So with the project progress only you should give, right? Always try to disperse the money to a third party. Like if he is buying a machine, give the check to the third party. Don't just put it to his account and just wait, right? Make sure that money will go into the purpose which we have given the facility. Always take the supporting documents. If the disbursement has done, take the supporting documents, you got the money. Then go on a visit. See whether this machine has been brought in, installed, working. Like that, go. Stock statements. Then insurances, EPL, environmental protection and license. You have to take all those things. And then annual review. It is a very important thing, because you grant the facility. If the customer service, don't just forget, review it annually. So you will come to know what have they taken money from another bank. Is there any payment delays? Reports from them you can know. So do an annual review. So you will know the exact position of the customer. Then we spoke about covenants, positive and negative covenants. It's good to have covenants, but if you are not monitoring the covenants, no point of putting covenants. Why are we putting covenants? In order to maintain the risk profile of the customer, right? That's why we put covenants. However, if you are not monitoring the covenants, no point putting the covenants, right? Monthly repayment should be monitored. And the collateral, you have to visit the collateral at least annually, right? Then you will know whether they are maintaining it. Is the value is same, as they are deteriorated, any changes to the collateral, all those things you can identify. There is a below the at the end of the handout, you have a list where what you have to check, right? You can go through that. It is Annex 1. Then we spoke about early warning signals. which is the traffic light. Before anyone goes bad, they will show that they are going bad, right? So look at it. Then I told you operational management, investing, like that, different categories of early warning signal. You have a list of that also as the annex 2 to this handout, right? Then when the customer goes paying regularly, it's fine. If they come into areas, 1 month, 2 month areas, you should watch list. If a customer is more than a month in areas, you have to watch list. That means we have to monitor regularly these customers than just wait for them to come. So watch listing is a key. Like you see bad signs, right? From your portfolio, people are going to areas, 1 month areas, 30 days, 35 days, 40 days areas. Now you have to take that part of the portfolio separately and regularly monitor that. That is called watch listing, right? You check the watch customers. If we see any bad signals, early warning signals, areas is only a one early warning signal, but you have several early warning signals. You can put customers to watch list based on the risk profile. It is not necessarily the areas, right? So it can be areas or it can be any other trigger under the watch list. If you think there is a risk of non-payment, you have to put them to watch list and regularly monitor, right? Why we watch list? We don't want any sudden impact to our NPA. So, like we have 100 million customer, we don't care. Suddenly it hits NPA. And then we don't know, sudden surprises. If it is watch listed, you have been doing everything to prevent it's going bad. But if you can't prevent it, you know that you have done everything, this is the reason, now it's going to NPA. Then just say, oh, it has gone to NPA. No. So watch listing is very important. Then this is all this thing. Then it is the credit committee's duty to review the watch list. In going deep, it can be worry category and monitor. Just monitor means it is the areas we are just monitoring. Worry means it is more probable to go into NPL. So you have to have higher level looking at these kind of accounts. Right? Delisting is from the approving authority or the credit committees only. This evergreening is short-term facilities without settling roll over and roll over. So if you roll over facilities, it will be evergreen. That means it will never go to areas because you are rolling over the facilities. But actually money is not coming in, right? It should not be allowed. Then we will go to this handout, additional information handout, right? We were having the regular portfolio, then we came to Aries portfolio. Under the Aries portfolio, if the customer 1 day, 2 day areas, that is liquidity risk. But when it is continuously in areas, we have to watch list. That's the second bucket. If the customer is more than 30 days or 45 days in areas, we have to watch these customers, right? So when we are into watch listing, then the worst case is we can't do anything. Facility goes to NPA. right? So facilities will go to NPL. That means non-payment for more than 3 installments or 90 days in arrears, right? So NPL classification can be done based on two methods. Firstly, it is the number of days in arrears. As per the latest regulation, any facility which is more than 90 days into arrears has to be classified as a NPL facility, right? Otherwise, it can be based on the risk profile. If you think that this customer turnover is coming down continuously, so this will go to NPL. So you can watch list, and if you further think, okay, his market has been collapsed, so his main buyer has left him. So based on the risk category, though the customer is paying now, you are 100% sure it will hit the NPL. It will hit to a non-payment category, then to the NPL. In that scenario, you can classify a customer as NPL, non-performing at loan, or NPA, non-performing advances, based on the risk profile. NPL classification is from two sides. One is number of days in arrears, or based on the risk profile, right? Before going to this, based on the risk profile, how do we classify a customer on risk profile? The customer is in weak financial position. Business of the customer has become uncertain. The customer is decreasing. There are no assets, right? These are points we can look for when you are talking about risk profile. These are called objective evidence. Objective evidence. That means you are sure there has been a change to his risk profile, so the customer may go bad. Do you have any questions up to this point? Pre-monitoring, watch listing, and risk-based NPL classification. Others? Thank you. Any questions, or can I proceed? Okay, right, right. Then, when it comes to number of days into arrears, we classify customers based on the period, number of days in arrears. So, NPL classification based on number of days arrears, we have 4 categories. NPL again subdivided into 4 categories. First, as soon as the customer goes bad, we classify it as a specially mentioned category. NPL specially mentioned category. This is the table to identify specially mentioned category. Any order from the due date, when it is 90 days, it is NPL. 90 to 180 days in arrears, it is specially mentioned category. Credit facilities repayable in monthly installments, 3 months arrears, that's again 90 days, it is NPL specially mentioned category. Up to 6 months, it is specially mentioned. Basically, it is 90 to 180 days. With a small exception on credit card, 90 days to 120 days specially mentioned. All others are 90 to 108. From the due date, 90 days. If a OD we gave for 90 days, 91st day we start counting as day 1. From there, 90 days is NPL. We give a import facility, we give a 120-day facility. Up to 120 a day, it is a regular facility. 121st day, it is the first day in arrears. From there, it is 90 days, right? So first category under NPL is specially mentioned category. Then we go to substandard, right? Substandard facilities. That is 180 days to 360 days, or 6 installments to 12 installment. 12 installment. Credit card 120 to 180. Like that, another 6 months. It is specially substandard. Then we go to third category. It is called doubtful. 380 to 540, another 6 months, right? There is 6 months basis is going on. So you have to remember these tables. They have asked questions from this table. It is a pattern. 0 to 90 regular, 90 to 180, 180 to 360, 360 to 540, right? 3 months, 6 months, 12 months, 18 months. With the exception of credit cards, 90, 120, 120, 180, 180, 240. Right? Then the last category is loss category, above 540 days. That is 1.5 years. Right? It is 1.5 years. This 18 installments is 1.5 years, right? Loss category. So we have NPL. NPL is subdivided or subclassified into specially mentioned, specially mentioned, substandard, doubtful, and loss category. These are the subcategories we are in, right? Then when we want to reclassify, okay, customer goes to NPL, then if he settles everything at once, all the areas at once, immediately it becomes performing, right? If a customer settles the entire areas at once, customer becomes performing, right? If the customer does not pay the entire areas, but the bank, we use two words, restructuring and rescheduling. Restructuring is prior to going bad, right? NPL, going NPL, right? Then it is a performing facility. You don't have to have a watch period. But if you do the rescheduling after going to NPL, changes to the repayment schedule is called rescheduling, right? Repayment schedule is called rescheduling, right? When the customer goes bad, or that means to NPL, and you do a reschedule, then you have to watch the customer. You can't immediately take that customer into performing category. You have to watch based on this table, right? Specially mentioned category, you have to keep the customer in NPL for 90 days, that is 3 installments. Customer need to pay 3 installments consecutively for him or her to take it out from NPL and classify as a performing facility, right? If it is substandard, you have to wait for 6 months. If the customer pay 5 months perfectly and the 6th month he get 1 day delay, then you can't classify. you have to start counting another 6 months from the date of arrears, right? So if you want to classify a customer from NPL to performing, non-performing to performing, you have to watch the customer and get the repayments as per this schedule. Specially mentioned 3 months, substandard 6 months, substandard and doubtful 6 months. Loss category, it is 1 year customer need to pay regularly, right? Otherwise, you can't classify them as NPL. And again, once you reschedule, you have to watch for reschedule or restructure. You have to watch for the number of days in arrears, pre-reschedule and after reschedule. If a customer is 60 days in arrears before the reschedulement, and after the reschedulement, if he goes bad for 30 days, it is 90 days. You have to keep him in NPA, right? So that is a very final thing, but at least you need to know these tables. Specially mentioned, substandard, doubtful, loss. Then how we are going to reclassify a customer? Then earlier there was a regulation like this customer has several facilities. When a customer has several facilities, if 30% of those facilities in value, not number of cases, in value goes NPL, the entire exposure goes NPL. That means if customer may be having 3-4 facilities to the value of 10 million. If 3 million goes NPL, even though other facilities he repay promptly, we have to mention all the exposure. That means entire 10 million and may impose it once the pandemic situation is over. Right? So we discussed the subcategories of NPL. Then we discuss what is the mechanism we adapt to reclassify NPL to performing category. Now we will go to provisioning. What is provisioning? Allocating part of our profits for future bad loans. For bad loans. Allocating part of our profits for bad loans. So it is a formula, right? We have, as per central bank guide, we have two types of provisioning. Firstly, we have the central bank time-based provisioning. It is normal provisioning is based on the number of days in arrears. Is time-based provisioning, right? You allocate part of your profits to compensate bad loans. That is provisioning, right? So initially we go with time-based provisioning. So if we have general provisioning and specific provisioning. General provisioning is regular portfolio, that is no arrears part, up to 90 days part, and specially mentioned category, right? Okay, no arrears, up to 90 days arrears, and specially mentioned category. The entire portfolio into 0.05, this one, right? Regular portfolio is no arrears up to 90 days. Still it is regular plus specially mentioned into 0.5%. That is the general provisioning for the entire portfolio of performing and substandard, specially mentioned category. Then for the facilities above specially mentioned, that is substandard, doubtful, and loss. This is the formula we use, right? This is the formula. We take this one. Don't take this one. Take this one, right? Capital outstanding minus FSV of the security into 20%. Substandard capital outstanding minus FSV of the security into 20%. If it is doubtful, capital outstanding minus FSV into 50%, right? Substandard, then doubtful. If it is a credit card, 20 increases to 25%. Why? Credit cards are normally clean facilities, right? 20 into 25% high risk. Okay. Then we come to loss category. Loss category. You have to do a small correction here. Loss category is loan capital outstanding, or is the capital outstanding minus, we mention it as a F, a factor. We have to discount the for sale value after loss category, right? Up to doubtful, you take the entire FSV. But from loss category, you don't take the entire FSV. You have to discount the FSV before taking 100%. Right? That is called haircut rule. Right? This dot has to be here. There has to be a dot here. Right? So once it is loss category, you have to discount the FSV. Right? This is the table we use to discount the FSV. Freehold, leasehold. Leasehold is we don't own the land, we have leased it out from the government. 33 years old, 99, 50 years old, 99 years. These are the three slabs we have. Right? So if it is a leasehold right period, you discount this way. If it is freehold, you discount this way. This again, how long the customer in loss category, right? How long the customer in loss category. First time, or if it is loss category, up to 12 months into loss category, it is 75% discounting factor. 12 months, 24 months, 60. 24 to 36, 50. Again, it is a pattern. You can just remember because previous papers, they have given these calculations. So you need to memorize, right? Provisioning, it is the allocation of profits for bad loans. right? Compensation for the bad loans, because though you have bad loans, you can't go back to your deposit holders and say, I have bad loans, so I can't pay. Therefore, in order to avoid that, in order to avoid any capital loss or profit deposit loss, what we do, from the profit we allocate some money for any shocks, right? So we have two types of provisioning. It is the time-based provisioning, what we are discussing now. Under time-based provisioning, we have general provisioning, which is regular portfolio, 1 day to 90 days Aries portfolio. The entire thing is called regular, plus specially mentioned category into 0.5%. Then we have substandard category, which is more than 180 days in arrears, right? In that case, how we do? Outstanding minus FSV within bracket, these two figures, outstanding minus FSV into 20%. When it goes to doubtful category, same formula within bracket, outstanding minus FSV into 50%, right? When it goes to loss category, it is outstanding minus FSV, we start discounting. When we go into loss category, we start discounting. Straight away, it is 75% of FSV, right? Up to 12 months, it is 75% of FSV. If it is more than 12 months into loss category, then it goes to 60%. Again, based on freehold or leasehold, 75 freehold, 60 leasehold. When it is 60 freehold, leasehold it is 50. Like that, we discount the FSV. That is called haircut rule in provisioning. Haircut rule, right? So you need to memorize these tables. NPL table, 4 tables on NPL. Then you have reclassification table and the provisioning formula and the haircut rule percentages that you have to memorize, because earlier they had asked questions from this section, right? So that covers the first part of provisioning, which is the time-based provisioning, right? Then we go to impairment provisioning. Impairment means it is not time-based. It is based on your knowledge on the risk of the customer, right? Now, earlier we used to do entirely purely on the number of days in arrears based provisioning. But after 2012 December, we started thinking about risk, right? This is risk-based provisioning. It is to your knowledge what is the risk of this customer. It is to your knowledge of the credit officer, what is the risk. If the customer is repaying, right? We just started the impairment. So what we do, each bank has to decide what is the significant level for the bank. That means if a facility or if an exposure goes bad, we have an impact. So different banks can decide based on different portfolio levels, size of the portfolio or the ticket size. Each bank, some bank can say, okay, if an exposure of above 100 million goes bad, we have an issue. Someone can come and say, no, 10 million is my significant. Anything goes bad, I will have an issue. Another one will come and say 25 million is my exposure level. If anything above 25 million goes bad, I will have an issue. Right? So first of all, each bank need to decide what is their significant level. Right? This is the portfolio, right? You decide the exposure significant level. All the exposures below the significant level, you keep aside. You put it to this bucket, right? Below the significant level exposure, right? Then above the significant level exposure is here. What you do, you have to check for objective evidence. I gave you a list of objective evidence. Customer is in NPL, customer is in arrears, customers' turnovers are coming down, they have lost their major markets, there are political issue like that, different criteria, 10 or 12 criteria I gave you. It is in the handout, right? I took you through. So you check your exposures based on those objective evidence. If you see, once you check each exposure, you say, okay, we said we have 25 customers. Out of that, 10 customers, they don't have any objective evidence. Everything is fine, no objective evidence, right? Then you will put that exposure also to this bucket here, right? Then we take the exposures which has the objective evidence. It can be several. Even a one single objective evidence, you take it separate. Then you go to this one, right? If objective evidence is here, what you do, you project the future repayments to the best knowledge of yours. How do you project the future repayment? You have, if it is a long-term loan, you have your repayment schedule. You decide, okay, he will pay regularly for the rest of the period, or he will or she will pay with a repayment delay, or they will not pay. You have to go for legal action. Then project. You are going for legal action. No repayments comes in. After 24 months, I sell the property and take. So at the end of the 24th month, you decide how much you will get. Right? Like that, you predict the cash flow. Once the cash flow is predicted, using the facility interest rate on lending rate, you discount the future cash flows to today's value. Find the present value. Right? Once you find the present value minus outstanding. If it is 0 or positive, you put that facilities exposures also here. Right? Wherever present value is less than the outstanding, you have to quantify that and make a provisioning. That is called individual impairment. Firstly, decide the significant level, take the above significant level facilities, check for the objective evidence. If there is objective evidence, predict the future cash flows, discount the future cash flows, find out whether there is a difference between present value and the outstanding. If there is a difference, that means outstanding is more than present value, that amount you need to provide. That is called individual impairment. It is your left side of the diagram. Then we go to the other side. It is the collective impairment. Right? We have lower than the significant level facilities, no objective evidence facilities, and the cash flows positive facilities. That means present value is 0, present value minus outstanding balance is 0 or positive, right? Those facilities, you take it to the collective bucket. So you have a bucket full of different exposures. This bucket, whatever within the bucket, you divide it to sub buckets. It can be term loans, PODs, housing loans, leasing, credit cards, like that, different facilities. Based on the facilities, you divide the exposure. Then you base on the past historical loss rates. That means if a facility goes bad, like we take example of a TOD, if a facility goes bad, normally we can recover 60%. That means 40% we lose. So you take that facility. Then we have economic factor, that is inflation, dollar exchange, consumer price, all those different things. We decide the economic factor as well. This is a complex calculation on this. What you have to understand is collective impairment is done based on the loss parameters of different products, not individual people. Based on that, you do a calculation and you allocate profits, or that is called collective impairment. Right? You have two types of impairment: individual impairment and collective impairment. Individual impairment is equal, almost like the specific impairment on time-based provisioning. Collective impairment is equal to general provisioning, right? It is bucket movement. So that is impairment. So it is very easy to tell, but it is not an easy process like the time-based. But you have to have an idea. Specific level, objective evidence, objective evidence checking, then cash flow projection, discounting using the facility interest rate. If a facility is was rescheduled, you use the original interest rate of that rescheduled facility. Currently, I have 14% facility, you reschedule to 10%, you use the 14%, not the 10%. Right? You project the cash flows, you discount, find out the present value minus outstanding. If it is negative, you do a provision. If it is positive, take it to the bucket. All the collectively less significant ones, no objective evidence one, or positive cash flow one, you take it to one bucket. And then what you do, separate the exposures to different products. Based on the product's performance, loss parameters, economic parameters, you do a calculation to come into collective impairment. Individual impairment is based on the each customer's risk profile. Collective impairment is based on the product risk profile, obligor risk profile, and facility risk profile, collective. So that is called impairment process or impairment provisioning. Any questions up to now? I'm done with the recovery part. I'm going to start a new one. Before that, anything you want to ask? Any questions, please? Can I proceed? If no question, but I want you to go through this presentation once again today, and next time you need to ask me any questions if you can't. Okay. Are we to continue with? What do you mean by that, Aruna?
So are we going to stop the DPD days and continue with impairments, or are we continue both?
We do both. We do both up to now. Even now we do both. We do the impairment. Basically, we are going towards impairment, right? This is what the Basel wanted. So we are pushing towards impairment, but what we do both calculation and we provide the larger one. And highest provisioning one we provide. So we are pushing towards impairment, pure impairment, because it is purely based on risk profile of a customer, not just areas. Even before areas, we are going to provide. From the day one, we are going to provide. Am I clear to you? Okay. Any other questions? If no questions, I'm going to proceed, but I want you to go through this presentation again and come up with any questions if you have next week, right? Then we go to credit rating. You can see the presentation now, right? Yeah. So we will discuss what are credit rating, external rating, internal rating, and those things. This is a detailed one, but I'm taking you only the relevant one. For your knowledge, you can go through. Right? Definition of a credit rating. What is a credit rating? Assessment of the credit worthiness of a borrower in general. Right? We are assessing the credit worthiness. It can be a borrower, or it can be just a borrower, or it can be an instrument. So we can define it as assessment of the credit worthiness of a borrower in general terms, or with respect to the particular debt or financial obligation. That means, okay, you talk about debentures. We take a risk rating. Risk rating will give a guideline, general guideline on credit worthiness. That means, will this customer repay you? If it is a debenture, if you invest, will you be able to collect your money back? That is the risk rating, right? Credit worthiness of a customer. It can be assigned to any entity who wants to borrow. It can be an individual, it can be a corporate, it can be a government, it can be a country. Like that, any individual or entity can be given a risk rating. Why? It shows only what is the credit worthiness of our customer, right? You know that we had been downgraded by international rating agencies. We were at BB minus. Today we are at CCC. We will discuss those things. So that is our credit worthiness at the eyes of those international agencies, right? So risk rating is the assessment of the credit worthiness of a borrower in general terms, or it can be an instrument as well. Type of ratings, you have external rating, that's what I just informed, and the internal credit rating. Right? Credit rating can be external or internal. External is some third party. Those third parties are called rating agencies, which Moody, Standard and Poor, like that. There are 75 rating agencies in the world. If we are getting a rating from those external party, it is an external rating. Regulator want us to rate each and every customer of ours, whether it is retail customer or a corporate or SME customer, you have to give a risk rating, because risk rating indicates the credit worthiness of the customer. If it is a internal rating, it is our risk rating for in our own customers. If it is external, third party is doing a rating, external and internal rating. Then rating methodologies, we have two things: point in time rating, PIT, and through the cycle rating, TTC. Point in time means now economy, our position is coming. Economy is a curve, right? It goes up, comes down, goes up, comes down, like it is, we call a sine curve. Right? Whoever has done maths, you know what is a sine curve is. Right? It is a curve. Goes up, comes down, goes up, comes down, like that. Right? So if you just take a point, like, okay, you take a point today, we are not sure about the economy. Right? In that kind of a scenario, even marginally good customers, we put it to bad lot. Right? See, if today someone comes and asks for a TOD, we rarely give. Even they have been good, but we are not sure about the environment. So it may be different. When a downturn in the economy, we always tend to be very careful. When a upturn in the economy, even a marginal customer is considered to be good. So there is a difference between these two: upward economy pointing down and downward economy pointing time. Right? But through the cycle one, we do a long-term calculation for risk rating. Upward and downward, we take both ratings and decide on the final rating. It is 2 points in the curve, upward and downward. What is external rating? Rating assigned by independent company that evaluate financial and non-financial conditions. When you are granting a rating, they evaluate financial, they evaluate non-financial. We have 4 rating methodologies we will look at shortly. A rating is an evaluation report of how well or bad the company performs in absolute terms, how the company is performing, because they are giving the credit worthiness. Right? It is nothing. It is only the credit worthiness. You can compare 2 customers using the credit worthiness without knowing anything else. Like we take 2 things, just an example. Aries and Brandix. Aries AAA, Brandix AA+. So AAA is the best, AA+ is the second. So if both comes together to a bank, everyone prefer the best credit worthy person. Right? We use a terminology called risk return trade-off. I have told you this earlier as well. Higher the risk, higher the return, lower the risk, lower the return. If you are going for very good credit rated customers, your returns will be lower. Why? You can't charge more. For the best customers, you are giving the lowest rate. Right? When we discuss our credit cultures, we discuss value driven, profit driven, market share driven, and target driven. Value driven is portfolio quality. Then you look at all the top 10 customers only. So high credit rating customers. Okay. So rating agency, that means the external agency is giving you a rating, that is called external rating. So this indicates the credit worthiness. This will be taken from your financial and non-financial both together. Right? Quantitative and qualitative information. Key things you should know about rating: opinion about the relative credit risk. This is only credit worthiness, nothing else. They are not talking about anything else. It is only credit worthiness. It is not a buy or sell decision. It does not indicate anything about the portfolio quality of this customer, or it does not indicate anything about the liquidity. Right? It is only the credit worthiness. If you give money, your probability of recovering that. If you deposit money, your probability of recovering that. That is the credit worthiness. Sometimes, some countries, regulator wants your companies to be rated if you want to list. Right? Because it shows a credit worthiness. Factors influencing credit rating: stable earnings, capital, earnings. Earnings has to be stable. 1 year very high earnings, second year no earnings, no. If you want high rating, you have to have a stable earning or capital. Then the political stability is very, very important. Whenever a country has a political stability, that will be rated high. Consistent earning. Every year you earn, right? And it has to be consistent. 500 million, 500 million, 500, 200, 300, 500, 600, no. 500, 550, 560, like that, consistent. Then you get a high rating. Whereas if you have legislative changes, significant decline in profits, material alteration to governance structure, breach of security covenants, failure to comply with regulatory, these kind of negative things will drop your credit rating. Legislative changes, if you are looking at tax changes and which affect the companies, in general, companies will be rated low. If your profits are coming down, rating will be low. Suddenly your auditors change, compliance officers change, all those things, you will be rated low. Breach of covenants, security, there are delays in repayments, there are court cases, those things you will be rated low. Regulatory requirement, if there is a regulatory requirement and you are not complying, it can be environmental protection, it can be labor, it can be anything, regulator required, but you are breaching that, then you will be rated low. How to bring high rates, stable capital and profitability, consistency, and stable political background, stable political environment. That will bring a company's or government position up. It will bring down major legislation changes, significant decline in profit, governance structure, like that. Those things will drag you down. Rating agency is an independent agency. It is a profit agency, not a non-profit organization. It is a business organization, but they are specialized in evaluating customers and providing rating, creditworthiness reports to others. Right? So when the rating agency, the scope is not only to limit to the rating of debt, but undertake financial analysis also. When, as I gave you a example, Haley's and Phoenix, if you Brandix, if you have a rating, what happens is even a layman who doesn't know how to do a evaluation will know, okay, this company is better than this company. So if you want to borrow, invest, you can decide on that. Therefore, your risk capital in the market will increase because of this rating. Last point, increase the total supply of risk capital in the economy, leading to stronger growth. It is also open to capital markets to categorize the borrower who might otherwise be shut out of altogether. So everyone can't expect to do our own investment calculation, right? Evaluation. So when you have rating agency reports like this, you can easily understand which one is better, which one is bad. There are 75, as I told you earlier, 75 rating agencies in the world. These are few of them. You have to memorize this. They have asked questions from this one as well. The blue one, the top one, investment grade. That means any facility which is any company or debt instrument which is good for long-term investment is in the investment grade, right? Triple A is the best grade. Default is the lowest grade. BB, triple B minus and above is investment grade. This one, double A to B, triple C, sorry, triple C, A to triple C, you can have plus and minus. That means double A plus, double A minus, BB plus, BB minus, right? Like that, you can have additional, but these are the classifications. Extremely strong capacity to meet financial commitment, highest rating. BB plus and below it is speculative grades. That means good for short-term investment, not for long-term investment. We were here, BB minus, and now we are here. Currently vulnerable and dependent on favorable business, financial and economic conditions to meet financial. We have been ranked here. Right? We have only few more to go if we hit down. So everyone should work towards getting increased. This is the rating scales based on Moody, Standard and Poor. This, I don't think you need to memorize this, but you need to memorize this. This is the one. Earlier we were BB, currently it is C. This is my bank's rating. This is my bank's rating. I told you the methodologies we use for external rating methodologies. There are two areas to cover: business analysis, financial analysis, management evaluation, and fundamental analysis. These are the four areas they cover when they are coming into a full scale rating, right? Business analysis covers an analysis of industry risk, market position, operating efficiencies, legal positions, like that. Financial analysis of accounting quality, earning protection, cash flow, and this. Like that, you have different categories. If anyone is interested, I'm doing only up to this. From here, you have those details. They have never asked questions from this side because I used to teach, but they're not asking anything from this, so I'm not wasting your time. These are details for your knowledge. You can go through this. Use of the external rating scale. Then I'll jump here. Use of external rating scale, methods for lenders to assess the credit worthiness. This is what I have been telling you. Sovereign rating, overall economic condition. Whenever someone wants to invest in our stock market, whenever they want foreign direct investment to come into a country, they will look at the sovereign rating. And again, when our country or any country wants to go and borrow from another country, they look at the sovereign rating. That is the credit worthiness of this country. Institutional investors rely on sovereign rating investment. The same thing, credit rating can be issued to individual companies, debt instruments, which I told. Sometimes it is regulatory required, so this can be asked. It is one point which they can ask questions. Limitation of external ratings. That is, there is a limitation. What are they? Rating has been done on point in time, PIT, right? Through the cycle. TTC, we don't do normally because it takes long evaluation, right? So if you don't re-evaluate customer regularly, you will have wrong picture, right? When the financial crisis hit, JP Morgan, Northern Star, all banks were AAA banks. It were highest rated banks, but it collapsed. Basically, financial crisis had because of the liquidity crisis, not credit worthiness. So one limitation is they don't downgrade very frequently. Other criticism they have is rating agencies are profit-making agencies. They are paid by the person who wants a rating, so they can influence. They paid by the company itself. Some ratings they have done mistakes. That is the problem. Sudden downgrade. What happened to us? The best example is Sri Lanka. We were downgraded 3 times during this 1.5 years. Once they downgraded us 2 notches at a stretch. So what happened when rating agencies downgrade us? Our cost of borrowing goes up. High capital cost will occur. Then it is a burden to economy again. Then we come to internal rating. All banks are required to assign internal rating across all their product credit activities, including consumer portfolio, credit card customers, everyone. We have to rate. Whoever borrows from the bank, you have to rate. This rating has to be obligo rating, that is the person, and the facile rating, that is based on the facility. Like if it is a OD, it is a low rated one because it is high risk, right? Housing loan, long-term loan, high rated products because it is secured and essential. Like that, you have to classify. Use of the internal rating, we will, I think next week we are starting the risk. We will talk about Basel. So their capital allocation will require a rating agency, rating for each customer. Capital allocation is based on rating. And this is a risk management tool. Why? You rate the customer. That means you categorize your customers based on the credit worthiness of them. Right? Then best customers, you don't need to do much. But for other customers, based on the risk rating, you can decide what are the exposures you give, what are the monitoring mechanism you would give, all those things can be decided based on rating. So risk rating is required for capital allocation and risk management tool we need. Factors to be considered when establishing a risk rating. When you are establishing a risk rating, you have to look at the length of time the customer was with the bank, conduct, past repayment, integrity of the people, market reputation, financial indicator, sensitivity to political, technological, and those things. So, again, look at this. It is a combination of quantitative and qualitative factors. So, customer who had been with the bank for long get scored higher than a new customer. Again, having collateral is a positive thing. Additional factors, collateral, repayment period. Short-term borrowing is a low case than a long-term borrowing because I have shown you a graph with time risk increases. Additional covenants you can put, it is a positive side. Pricing, like that. You need to have regular review on risk ratings. Then if the ratings are coming down based on regular reviews, you have to watchlist the customer. I told you watchlisting is based on the risk profile. So rating gives you the risk profile. Final authority on the risk rating would be credit committee and the integrated risk management unit. They are because always and never business line should be involved in deciding the risk rating methodology. We can do the risk rating, but defining and monitoring and correcting has to be from an independent party, not from us. Right. So what we discuss under risk rating is the credit worthiness of a customer. It can be a sovereign, business entity, person, or even it can be a instrument like debentures, shares, all those things. Ratings are two types, external ratings and internal ratings. External ratings are done by an independent third party, specialized company who evaluate a customer and provide us the credit rating. Credit rating indicates only a credit worthiness. If you give money, you will be able to, what is the probability that you will be able to collect it back. It does not indicate anything about the liquidity. It does not indicate anything about the quality, portfolio quality. And it is not a buy or sell direction. It is only a report on credit worthiness of the customer. When we are looking at the credit rating, you have to look at quantitative and qualitative all factors. You have to look at. I gave you 4 methodologies to look at. Management, finance, like that, 4 methodologies were there. Right? So these external parties who are doing risk rating are called external rating agencies. There are 75 rating agencies in the world. Then rating also starts from AAA, which is the best, and the lowest is D. Rating can be divided into speculative rating grade and investment grade. Anything triple A to triple B, it is investment rating, which is long-term, good for long-term investment. Speculative ratings are short-term rated, short-term ideas, right? So Sri Lanka had been downgraded from BB minus to triple C, right? When a rating goes down, that means our credit worthiness has been ranked low. similar situations, what happened? Our cost of capital, our borrowing cost increases. Right? How to get your rating up? It is the stable and consistent profitability and capital, then political stability. All those things will take your rating up. Ratings comes down, legislative changes, profitability changes, governance changes, all those things will drag the rating down. Similarly, internal rating. We need to have an internal rating for our entire portfolio. That will also be calculated based on the qualitative and quantitative factors. Each and every exposure, lending exposure, need to be rated. That is a requirement. You look at profitability, length, market reputation, everything when you are doing a rating. Internal ratings can be obligo rating or facility rating, both. Right? Obligo and facility. Just hold on. Oh. Oh. Lecture එකේ වෙලා කතා කරනවා මට. Right? So it can be external and it can be obligo, that is for a person, or facility, it can be just for ODs or short term, more like that. Yes. So that is all about rating. So I have done the recovery and rating today. So any question, I'm done with it now. I'm happy to answer any questions if you have. Sorry about what happened during the day today. I didn't see that I was thrown out of the link. If you have any questions, you can ask me. Otherwise, thank you very much for today. But please go through it, and if you have any questions, ask me next week at least.